everyone?
No,
Yes, sir.
sir.
Yeah, you're able to see, no, Zarina? Yeah. Sure. The first question, like anyone can take the initiative to give the answer for the first one. Okay. Come on. Tell me the answer for the first one. Primary purpose of statement of financial position is to reflect what? Fair value of the firm's assets at some moment in time, status of firm's assets in case of forced liquidation of the firm, success of company's operations for a given amount of time, items of value, debt and net worth.
Mm,
I think D, sir.
Hmm? Yeah, items of
D.
values, assets,
yeah.
debt and also net worth they are going to tell you. Okay, net worth is always nothing but the equity. Fine.
Yes.
Now this is the answer for the first one. Let's go for the second question.
Prepaid expense are valued on the statement of financial.
Prepaid expenses are valued on statement of financial position at the cost to acquire the asset, face value, collectible at maturity, cost to acquire minus accumulated amortization, cost less expired or used portion. So can I say cost less expired or used portion? Correct? Is it so?
Yes, sir. Cost plus
Yeah.
expired. Yes. Used portion.
Why? See, prepaid expenses, let's say prepaid rent, prepaid insurance are reported on the balance sheet at cost minus like expired or used portion. That means you have already paid it, so we have to subtract, isn't it so? And it's a
Yeah.
current asset. Fine? Yeah. So cost less expired. That means you have already paid. Okay.
Yeah.
Yeah, yeah. Just a second. Just a second. So cost less expired or used portion. Okay. Next. Next question's answer. So when you see the statement of financial position, it allows the investors to assess all of the following except the
Efficiency which.
efficiency with
A.
which enterprise assets are used. We know
Yes.
from the statement
A.
of financial position or not.
Efficiency with
Yeah.
enterprise assets are
How
used.
come? How come you know the efficiency of something? You cannot know that. Liquidity and financial. Can you know that?
Liquidity and financial
No, no, no.
flexibility.
Can you know this? Yes, we can know this, na? Efficiency with which enterprise assets are used. That means how you are using the assets every year. You are removing the depreciation and everything from that. Correct?
Yeah.
So a statement of financial position allows investors to assess all of the following. So we see how efficiently the enterprise is using the asset. We also know about the liquidity and financial flexibility of the enterprise. We know
Capital.
about the capital, but net realizable value of enterprise assets we don't know from the balance sheet. We know it from the market. Correct?
Mm, yeah. Yeah.
So next one. So accounting equation reflects the dash. See, accounting equation is assets minus liabilities equity. So entity point of view is not there. Fund theory, no. Proprietary point of view, yes. Why? Because equity is nothing but something which is left over after removing liabilities from assets. Am I right?
Yeah.
So proprietary point of view. So this all like you will be knowing much more in details if you read the textbook properly. Of course, like Hawk book may not give some of these details. So I can share Gleam's textbook with you so that whenever you solve Gleam questions, you can read that once and you can do the questions, correct?
Okay.
I'll share it, I'll share it. Okay. Now, next one. What about the fifth question?
Long-term obligation that are
Long-term obligations that are or will become callable by the creditor because the debtor's violation of provision of the debt agreement at the balance sheet date should be classified as dash. See, long-term obligations are what?
long-term liabilities.
Yeah, long-term obligations are long-term liabilities that are or
Which
will
are more
become
than 6 months, right, sir?
more than 1 year actually.
1 year. Okay.
Yeah, will become callable by the creditor because of the debtor's violation of provision of debt agreement. That means he has not paid, it seems. Okay. So what will you call it?
Contingent liabilities until the one
No.
liability and less the debt of
Long-term liability, sir.
Yeah, see, no, this one, na, long-term obligations that are or will become callable by creditor because of debtor's violation of provision at the balance sheet date should be. That means if he pays within a year, okay, then it is current liability. So long-term liabilities, will it be? Because he's calling it the creditor is calling because debtor has violated some provision of debt agreement at the balance sheet date. Maybe long-term obligations is something if it continues beyond a year. If it is if something like he's repaying within a year, so it will not be called as long-term liabilities, na?
yeah.
So current liabilities until creditor has waived the right to demand repayment for more than 1 year from the balance sheet date. If he tells that you can make the payment after 1 year, then it's okay. But he is demanding if the money is paid within 1 year, it will be called as what?
Current
Current
liability.
liabilities, correct. Next one. The statement of financial position is intended to help investors and creditors for what?
Economic performance.
Sorry?
Sir, please down the screen.
Yeah.
Performance of value changes the ownership.
Yes, sir.
It is nothing but, see, when I speak about balance sheet, statement of financial position is intended to help investors and creditors to evaluate economic resources and obligations of the firm, na? Assets and liabilities. Correct? Isn't it so?
Economic performance.
Yeah, economic resources are nothing but the assets and obligations are liability. So when you see the balance sheet or statement of financial position, it will help investors and creditors to what? To value the assets and liabilities. Am I right?
Yeah.
So option B. Okay. Go for the next question.
Purchase for treasury stock is recorded on the statement of financial position as a decrease in shareholder equity.
Increase in assets, sir.
No, see, when you buy treasury stock, it is decrease in equity, na?
But
Yeah.
See, what happens? You may be having some outstanding shares, correct? So suppose there are 10,000 outstanding shares. You are buying 1,000 shares out of that. So you have now 9,000 shares, correct?
Okay.
No,
Oh,
so then your equity is decreasing, na?
oh,
We already
I
discussed
went
about this.
through.
We already
Yes, sir.
discussed. Yeah, we discussed about this.
Yes,
Isn't it
sir.
so?
I just gone through a perspective of manufacturing the stock. I was going through that.
No, treasury stock is stock
Treasury stock.
repurchase.
Yes, 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 sir.
Stock
I that was
repurchase.
my mistake.
Yeah, or share buyback. Next one. Leave it, leave it. Now some practical questions we'll do. So we have done till 7 questions. Can you do this question? 13th one.
Account payable of 30,000. Construction loan of amount of should this liability be recorded in the balance sheet?
So what
Okay.
is option C and D?
Sorry.
C and D option C. You can't see the C and D. Only A and B. Yeah.
Just a second. Just a second. So what does this question tell? Company has outstanding accounts payable of $30,000 and a short-term construction loan in amount of this much at the year end.
Hmm.
So accounts payable is a current liability, and they've taken a short-term construction loan. It's nothing but it is also something which is like for short span of time. Am I right?
Yeah, at the year end.
Yeah. So this is the loan was refinanced through, but see, they have given some condition. It was refinanced through long-term bonds, correct?
After year, huh?
After year end, but before issuance of financial statements, correct?
Yes.
Then how would these liabilities be recorded in the balance sheet is the question. So what is your take? There are options, like there are 4 options here. See,
Correct.
company has, see, 30,000 is a current liability, anyone can say.
Yeah.
And it's a short-term construction loan in amount of this much at year end. The loan was refinanced through issue of long-term bonds after year end, but before issue of financial statements. So how did they get this loan?
Total current
Sure.
liabilities as well.
Sorry.
Current liabilities of 1,30,000.
According to me, I would say it is a non-current liability. But why will I say non-current liability? See, accounts payable are definitely current liabilities, correct?
Yeah.
Because they are taken in one operating cycle only. That means within a year.
Yes.
But here, short-term debt is refinanced by a post-balance sheet date issuance of long-term debt. That means after making the financial statements at the end of the year, SOFP, okay, they have what they have done. They refinanced. Short-term debt is refinanced. What do you mean by finance? Finance is once a finance has been done, again you have financed it, correct?
Reinvestment.
Yeah, refinance. Yeah, again taken a loan. So short-term debt is refinanced by, see, if I have taken a loan on some part of my asset, okay, So let's say this is my asset. In this 20% I have a equity and 80% I have a loan. I can get a finance on this 20% also. Correct. I can get it. I can get that again financed. Correct.
Yeah.
So it is done after the like issuance of long-term debt. Okay. Issuance of balance sheet. Okay. But we will classify it as a long-term debt only. Why?
Because it has
Because
done
you have
finance.
you are having some ability to like what we say refinance your asset with a long term loan, correct or wrong?
Yeah.
Isn't it so?
Yes, sir.
Yeah.
So the short term construction loan when we see here, again you are refinancing, maybe again you will refinance. Okay, so this refinancing can go on. See, what happens is when you make a building or apartment, you do the construction phase wise, first phase, second phase, third phase, fourth phase, fifth phase. Fine. Are you going to make this asset in a year itself?
No.
No.
So the construction will take some time, and for that again refinancing and all these things would be going on happening. It's not like you're settling this obligation within a year. This obligation will be still continuing for long time. So will you classify this as a long term liability or short term liability?
Long
Long.
Because it is not something which it is getting stopped, it is continuing. Am I right or wrong?
Yeah.
Yes.
And they did not say that how will you show this liability in the balance sheet of current year. In general, in the balance sheet, how are you going to show? If I say only for this year, current portion of long term debt is a current liability, correct?
Yeah.
Current portion of a long term debt is what?
Current liability.
Current liability. But did they say you that in this year balance sheet, what are you going to say? What are you going to show for that?
No, not.
Did they tell you? No, they did not say anything about it. They did not say anything about that in this year. How are you going to show? So, in the future, this particular construction, short-term construction loan, which is again refinanced and will be refinanced again and again, the motive is you cannot clear that as soon as possible. It will take long time for it to clear. So this will be going on and it will be continuing. So it is always termed as a non-current liability. Okay. So the
Yeah.
answer option is C. Yeah. Yeah. Now can you go do this one?
On the financial.
Oh, item.
So a company has following items recorded in its financial records. Okay. And those are nothing but available for sale debt securities. Fine. Prepaid expenses, treasury stock. The total of the above items is shown as an asset on the statement of financial position is what? What will you show?
Available.
We will not take this treasury stock anyways. This treasury stock should be subtracted from share capital. Am I right? So only two things what we are going to take in the asset side is this. 6 lakhs is the answer. No, this theory questions I'm not leaving. Okay. This like we have done some 7-8 questions. Now we are doing some practical ones. We'll again do some 3-4 theory questions. Just do the 18th question.
Corporation.
See, today I will be taking the class till 2 p.m. only because I'll be leaving from office. Because there is this lunar eclipse, no? So that's the reason. Yes, I'm waiting for the answer.
Sir, 6 lakhs B.
Sorry,
B.
6,17,000. That's what is your answer is, madam.
Yes, sir.
Okay, so a corporation was incorporated on January 1st, year 6 with 500,000 from issuance of stock. So this is your equity, correct?
Yeah.
Borrowed funds is this, like debt, 75,000. Equity. During the first year of operations, net income was 25,000. So this net income would be a part of equity only. It is retained earnings. Okay.
Yeah.
Corporation paid a 2,000 cash dividend, so it will be subtracted from this. No additional activities affected equity in year 6. Corporation liabilities are increased to 94,000. So like there is an increment. How much is the increment? Please tell.
94,000.
94,000. So first of all, what we will do, what are they asking? Total assets should be reported as. So this is the liability side of balance sheet. It's a part of total of stockholders equity plus debt. So equity is how much? 500,000, correct?
Yes,
Correct
yes.
or wrong?
Plus,
So stock issuance is 25,000 minus 2,000 is cash dividend. So this becomes 5,23,000. Am I right?
yeah, 5,23,000.
So after that, what are you going to do? You are going to add your liabilities. It is increased to how much? 94,000 extra liabilities. So how much
Yeah.
it is? 6,17,000. So when this is the liabilities and equity side, the asset side should also be this much. So your answer is 6,17,000. Okay, good. Next one. If you want to note it down, I'll be waiting.
Oh, it's done, sir.
Yeah, Zarina, are you following? Zarina is
I
not
guess
online. Okay. So can you just do this question? Sorry, it's like, or else I'll zoom it if you can see that.
Yeah, zoom in, sir.
Yeah. Once see the details.
what is the question, sir? I'm not able to see the
They are
question.
asking the question as like this. Amount of total current assets.
Yeah.
Sir, can you please scroll up, sir?
Yeah.
Loans paid.
Yes, we have 23,400 pay.
Sir, can you please scroll down, sir?
1 minute.
Yes, yes.
Scroll down.
Sir, option D, please show me the D, sir. How much option D? D. Yeah. Sir, can you show me in one page?
Yes, madam.
Can you please show me in one page, sir?
5,000 A.
Madam, you're asking one face, but see, like, if I show in like this,
Yep,
you are
side
not
is
able
okay,
to see.
sir.
Yeah.
23,400 cash. Rent is 1 lakh. Scroll down, sir. We can minus the current liabilities also, sir. How can
No, they're asking only total current assets, madam.
yeah.
So it can be 35,000.
Answer?
That is my take.
Yeah, see, we will do this now. What is the big deal? So sales you won't take, cash you can take 23,400, accounts payable you won't take, rent expense you won't take, account receivable you take,
Yeah, I know.
COGS you won't take, land you won't take, unearned revenue, that is income received in advance you won't take, gain on sale you won't take, inventories you take.
Yeah,
Finish. Just tell me what's the answer.
35.
0, 8, 8, 9, 10, 0, 9, 10, 11,
35,000.
35, yeah, 35,000. Finish.
Okay, done.
That's done. We are done with a lot of these things. Now let's go for the income statement. Okay, come on, do this question.
Cost of goods manufactured by the entity for the current financial year. One lakh 12,000. Fiscal
The
year.
option C and D, please show me the option C and D.
1,10,000.
Option C, sir.
Option C.
Yeah.
So your option C is right. So what are they asking? Cost of goods manufactured. Okay.
Yeah. Yes, sir.
So what will you do about the cost of goods manufactured? How will you find? So sales is 1,60,000, correct? And they have given you the gross profit as well. Sales less gross profit is how much?
One,
48,000.
yeah,
So
48,000.
you'll be seeing what strange thing is writing. So sales less COGS is what? Gross profit. Am I right? Sales
Yeah,
less but what has happened here now?
they have given the year and
Yeah,
inventory.
they gave this one.
Closing inventory.
They are asking to find out this one. Am I right?
Yes, sir.
Now we'll take this here and bring this here. So sales minus gross profit is COGS. Do you agree?
Yes, yes.
So just subtract this. What will you get? 1,12,000. Can I say this is COGS? Can I say this is COGS? Please tell me.
Yes, sir, yes.
But what did they ask you?
Manufacture cost of goods manufactured by the.
Yes. So what we'll do is to get the goods what we have manufactured, the cost of that. What is left over with us? Finished goods, correct?
Hmm.
And ending finished goods 58,300. So when you add this, see, this is your cost of goods sold. They're asking us the cost of goods manufactured. That means whatever they have manufactured, what is the cost of that? Am I right?
Yes,
They're not asking you whatever the goods you have sold, what is the cost of that? Whatever you have manufactured is something which is with you right now. With you or not?
yes, yes. Current
Yeah.
fiscal year.
So now we added this and we got 1,70,300. This is what, just a second, I got a call, 2 minutes.
Year end current one.
Hello? Yes, hello.
Yes, sir.
See, what do you mean by cost of goods sold? See, you would have made some goods, okay? So that goods you have sold, okay? So the cost of that what you have sold is this. But you may have some leftover goods also. You may have because the information is given to you, correct? Year end finished goods.
Yeah.
So that leftover what I have added here, okay?
Hmm.
And year end finished goods inventory is leftover. Opening finished goods inventory. Do you think opening finished goods inventory is what will be leftover you or you would have utilized that?
You
See, when you started the year, the opening finished goods inventory you have utilized or it is still with you?
utilized.
Utilized, so we will subtract it. So what is
Yeah.
the opening finished goods inventory? 60,190. So what I have done is COGS plus ending finished goods inventory because it is with me minus opening finished
Inventory.
goods inventory which I have utilized. So my entire cost would be 1,10,110. So this is my cost of goods manufactured, COGM. And now onwards any question you get you have to apply this formula. Okay, please make the note of this.
Okay, sir.
Okay.
Yeah.
So next question. Do this.
Right, 100%.
Yeah. What's the answer?
Like 60%. D.
60.
D.
Okay.
60. Right. 9.
Okay. So this answer would be, so a retail entity maintains a markup 25% based on cost. So we'll take an equation 100 plus 25,
120.
125. This is markup based on cost. Markup based on cost. If it is on sales, then margin on sales, then 100 minus 25, 75. Pramod, are you following?
Yes, sir. Yeah, I'm
Yeah.
following.
Yeah. So this is cost price, profit, selling price. This is selling price, profit, cost price. Okay. So these are the two different equations you need to understand.
This is markup. Markup is addition and the margin on.
Margin is subtraction, and why it happens is like these two equations are very important. If they give selling price, you can find cost price. If they give cost price, you can find selling price. Okay. So a retail entity maintains a markup. So they always have a strategy to sell at 25% on cost. purchase of merchandise is 6,90,000. Okay, and like freight charges are this, sales, ending inventory, beginning inventory. So they're asking you what is the beginning inventory. So to find out beginning inventory, what will you do? Sorry. So what are they asking? They are asking beginning inventory. So for that, what is the formula you can use? You have COGS. You know about COGS, opening inventory plus purchases minus closing inventory. Am I right?
Yes.
sir.
Okay. So like cost of goods sold is like, how will you find out the cost of goods sold? So you don't even know what is this from the question. So how will you find out? Simply what you will do is your sales is 9 lakhs minus your purchase of merchandise inventory 6,90,000. So will you take 6,90,000 or you'll do some adjustment to this? You'll add the freight charges also. What will you do?
Add the freight charges.
It's like freight on purchases, correct? So, but we can find out the cost of goods sold because they have given us opening inventory, they did not give. Purchases they gave. Minus closing inventory is also there. They did not give the opening inventory, correct?
Yeah.
Yes, sir. They didn't get the.
Yeah, so beginning inventory plus purchases. Okay, let's see. So cost of goods sold is equal to opening inventory. This is what we want. Plus purchases 6,90,000 plus freight charges 25,000 because that is a expenditure added to purchase minus ending inventory 80,000. Can we do this? Can you do this or not? Hello, can you write
Yeah.
this or not?
Yes, but we have to find out COGS, no? Before
Yeah.
that.
So now what we have to do is, COGS is sales minus cost of goods sold.
Mm.
So plus freight charges is 25,000, correct?
Yes.
So what is like 6,90,000 plus 25? Can you tell me?
715. Sir.
7 lakhs.
Or else like why to do this? We can directly do this now. 100 plus 25 is 125, correct? So
Mm.
cost price, profit, selling price. Selling price is given to you as how much? 9 lakhs, correct?
9 lakhs.
9 lakhs.
Yeah.
Can you find out the cost price? How much is, if you can tell? 9 lakhs into 100 by 125. How much is that?
720.
7,20,000, sir.
7
7
lakh 20,000 is your COGS. So we'll take 7 lakh 20,000 and you put that in this equation and tell me what's the answer.
It's 80,000. 85,000, sir.
85?
85,000. 85,000.
That's right. Yes.
Okay.
Okay. So we will like again take one more session tomorrow for this, and we will do some questions from like some 10 questions from this again, and also from statement of changes in equity. What do you say? Shall we do do like that? Hello.
Okay.
Yeah, we'll do some 10 questions from this, 10 questions from that. And meanwhile, what I can do is I can allot some homework also to you in the coming sessions. Why? Because this entire PDF we are not supposed to do. What we have finished, only we will do that. So concepts of financial accounting is like once I give you the gleam material you read, you yourself can solve them because it's like your task to do. Cash flow, how we have not finished, we have to do this, we have not finished, this we have not finished. So need not do this all. Only we will restrict ourselves for this and this. Okay. This we have finished. These are the ones after finishing these chapters we'll go for these questions. Understood?
Okay.
Yeah, because next chapter what we are going to take, we will take tangible assets, tangible, intangible. These chapters we are going to take. We will do those questions only. We will do 30 questions on this, 30 questions on this. These kind of questions if we do, we'll get a very good idea about the kind of questions what they're going to ask in the exam, right?
Right.
Yeah. So okay, then tomorrow 1 p.m. again we'll meet and do some 20 questions tomorrow. And those two doubts what madam has sent and Suman's doubt also. Like after the class, however I'll be having time tomorrow, we can set for 10 more minutes and solve the doubts. Okay.
Okay.
Just remind me tomorrow. That's it. Just remind me. Right.
Okay.
Okay. Yeah. Thank you so much, Alafi. Thank you.
Thank you, sir.
Thank you. Thank you.